All right, good afternoon, everyone, and welcome to the latest episode of our free webinar series. I'm George Ozoude of Time Health Capital, alongside co-host Adebayo Fasanya of Dr. Breathe Easy Capital. Today, we have a very unique offering to give you as we bring on Marty Nichols of Physician First Bancorp. I've gotten to know Marty over the last several months as we have had both one-on-one discussions about his very interesting banking project, but also Marty is very active and engages on different webinars and social media platforms, giving very insightful input on physician finance and healthcare economics. He has over 30 years of experience as an orthopedic implant device, and he's an expert and a distributor as well. He holds 3 patents for robotic-assisted surgery, and he has experience working in healthcare tech startups and is a consultant for companies looking to bring these technologies to market. Marty also has experience as a consultant for physician-owned ASCs, which are ambulatory surgery centers. This afternoon, he'll actually be sharing his thoughts on the concept of physician-owned banks and how it can be a solution to funding challenges for different healthcare and physician-related endeavors. Marty, we are excited to hear about the project and about banking macroeconomics. Please take it from here. Questions are welcomed as we go, and leave them in the chat as well. Thanks.
Yeah, and I greatly appreciate it. I was blessed to meet these 2 gentlemen, and I've participated in several of these now with you, and they've been wonderful forums. I think that the thing that makes these forums the most useful is the interaction. Don't anybody out there feel any angst against interrupting me or taking me down a different direction. And one of the things I wanted to do today was I figured that my project and stuff would more or less take care of itself. So they challenged me to talk about a couple of things. What is the status of banks today? And then why a specialty bank, whether it be a medical specialty bank or other banks, what are the values of it? So I thought I'd focus most of the time on that. If you want to go a little bit deeper into what I'm doing, or you got questions about it, I'm happy to talk about it here at the end if we have some time, or even any other time on the own, or on our own on other deals. As I was prepping for this and as I was getting ready, I thought I'd start with what were we trying to solve? And the project I'm working on is we've basically taken the ownership model that was built around ambulatory surgery centers, where what we learned was that when you allow the physicians to invest a little bit of their own money, what happens is the throughput gets better, the working environment gets better, the cost actually came down for the same procedures that are done in ASCs versus what's done in a hospital, and the outcomes were actually better. So it was a win all the way across the road. One of the real challenges or biggest problems with it is because the regulatory issues that are put on physicians that are different than other industries is that the orthopedic surgeons are the only ones allowed to have the ownership, even though there's other physicians that play parts and roles in the care of these patients. And then even within that, it's limited to a subset of those physicians. Only the ones that do a certain amount of cases and have a certain investment level can actually then, or only the ones that can do a certain amount of business within that facility can actually have ownership. What we were trying to solve was basically 3 things. Since the time I've gotten into this industry, physicians have taken a cut and pay almost every single year. At the very best, they might get enough of an increase to match the increase in the cost of living. And what they've been told every year is that they can make it up in volume. So physicians, when I first got into this industry, it was interesting. For total joint arthroplasty, the physician made $52.50. We kept the patient in the hospital for 10 to 14 days. They were able to bill for rounding on that patient the next day with the outcomes of this deal. And today, what's interesting is that physician gets paid $1,043 for the same procedure. They've made the procedure so efficient that we're sending pretty close to half of these patients go home in the same day, and that will only increase. It will go bigger than that. And they have to take care of that patient for 90 days, the quote unquote episode of care for that 1,043. So we've hit a wall with a lot of these physicians and their ability to make it up in volume because there's just only so many hours in a day. And the other thing that's unique in the physician world versus a lot of other businesses and stuff is they've done a very good job of dividing physicians through regulatory challenges. Like I said, if you're a family practice doctor or a radiologist, even though you played a part in getting the x-rays or the images or seeing that patient pre-surgical and stuff, you don't get to participate in the ownership of the ASC. So we've divided physicians down that level. And then even within the specialties themselves, the orthopedic physicians weren't allowed to really come together and consolidate until recently. So within a community, the surgeons looked at their peers and partners as rather than being business partners, but looked at them more as competition, which really limited their ability to come together in a common entity. One of the things that we were trying to solve and that we did solve is with the banking situation that's completely outside of Stark. And what we hope to do is bring physicians together in an investment deal. And the byproduct of it will be the owning of the bank will make its money in and of itself. And it's something that they can do, you do every day anyway. The only learning curve in this is learning your account number and your routing number and changing it. But more importantly, it should bring physicians together that were formerly competed or were from different things and bring a brain trust of them together into a common entity that's outside of Stark. One of the things that's always challenged me in all of my career is I consistently hear the statement that one of the reasons that healthcare is so expensive is because physicians aren't traditionally good business people. And it's truly one of the most bastardized statements that was ever put out there. The reality of it is physicians represent the upper 5 percentile of the intellectual scale, as well as the work scale. Physicians make money not because they get paid so much, but really because they work so hard. They've been cut every single year. And the reality of it is I embrace physicians as business people and firmly believe that if we allow them to be business people and play like the others do, that they will be the best of the best. And the truth of the matter is there was a reason why business was purposely left from physicians' curriculum. And that's plain and simply orthopedics is where I spent most of my time, but you can apply it to general or to cardiothoracic as well. If you're having an appendectomy in the middle of the night, or you had a heart attack, or you have an open tib-fib fracture, the people that founded medicine realized that your ability to pay shouldn't affect the doctor's diagnosis and treatment of your malady, right? So they thought purposely keep business out of this, but we'll put them into a role or a place where they can actually make money. Of course, they always still do that. Make money when they're coming, make money by working hard. So that's why we're out there. And then the other thing that we wanted to solve in doing this is the transition from practicing to retirement. And it was on one of these webinar series that I really heard one of the most profound statements that I'd heard in a long time. And that was a gentleman was talking about the differences between rich and wealthy and how wealth transitions to another generation. You can pass off wealth. Rich is literally in the moment. And that really describes the physician in the physician's world. Physicians do very well, but not because they're overpaid, simply because they work so many hours. But even as a family practice doctor and stuff, or an orthopedic surgeon or whatever you are, at best, you used to be able to sell your practice for roughly about 20 cents on the dollar when you went to retire, because the attitude of the colleagues around you were about to retire. You can only work about so long anyway. So your patients were going to come out onto the market. So they would look at your practice and they'd say, I can pay this person a substantial amount of money for their practice. But are these patients going to stay with me? Are they going to like me, or will they go and find another doctor anyway? What am I really buying? And this is something that's really driven the banks nuts as well, too. The banks really struggle to understand that physicians in the past have not really had a huge drive to own the building that their office was in. That was a distraction for them, because the truth of the matter is we've all seen the restaurant in downtown that was hip, cool, and trendy. And it was a small restaurant that had lines of people waiting outside the front of it, and the food and the service was good. And then to get bigger, they were landlocked, so they had to move 2 miles down the road, and they open up a bigger restaurant in a bigger place in another location, and it fails because the ambience wasn't there. Whatever magic and stuff was there, and thus the concept of location was certain things like restaurants and retail businesses. But the physician's world isn't that way. In the physician's world, the value is your charts, it's your patients. And if a physician moves 2 miles down the road and we as a patient get the card in the mail saying, hey, I've moved my office, our first thought isn't, I need to get a new doctor. Our first thought is we look at it and say, how much further am I going to have to drive to see that physician? And that really drives these bankers nuts, is that when they want to loan you money or they want to work with something in your practice, and if you're trying to buy a piece of capital, if it's something as simple as a $50,000 ultrasound to work in your office, or if it's a laser to do laser procedures, when you're trying to buy that capital, the next thing they ask is, where are you going to place that capital? And then how much equity do you have in that building? And when they hear that you have a rental, that you don't even own the building, it just blows their mind to say, why would you buy this expensive piece of capital? In the case of orthopedics, an MRI was a great example. An MRI was $1 million for the deal. And the doctor explains to the bank how they make money off an MRI, and then they ask where they're putting it, and they tell them they're putting it in a leased building, and they go, wait a minute, why would you put a $1 million piece of capital into a building that you don't even own? So it just really gave fits, and that's the reason, and that's one of the niches that we intend to fill. Is that's one of the reasons so many of the manufacturers of medical equipment, and this could be the MRIs, imaging is strong in it. It could be OR tables or exam tables, or even the chairs and furniture in a lot of your clinics and stuff. A lot of those now are financed by the manufacturers. You sit down and you negotiate the deal with the manufacturer, and then when you're done, they slide you across the contract that's got interest in it attached to it, and you look at it and think, or your CFO looks at it and thinks, I could go down and try to explain this to my banker, how it makes us money, and I'm probably not going to get any better interest rate than they're offering me anyway. So you sign, and not only do you then buy the capital equipment from that person, you pay them interest. The concept of what we're doing and the value to physicians having ownership in the bank that they deal with is a couple of fold. Number one, the bank will understand your business because it's focused on, and the people working there all understand medical industry. You're not going to have to explain to them how these things make you money or what the value of them lending the money is. And the second byproduct of it is when you borrow the money, if you were going to pay 6% to Siemens or to Philips or to GE, now what you're simply going to be doing is paying the interest to yourself. And it's outside of Stark. It's perfectly legal. The only thing that you can't do within that scenario, which a bank doesn't want to do anyway, is because of anti-kickback regulations and stuff, what a bank can't do is say, I'm going to give this person a loan only because they're an investor in the bank. That's how you get into all sorts of trouble with it. Or you can't give hugely favorable terms. If the going interest rate is 6%, you can't do 2% loans where you're losing money by doing the loan just because they're a member of the bank. And those are things you wouldn't do anyway.
Can I jump in here? Perfect time.
Absolutely.
For a relevant question. I think banks now are, in fact, it seems like they are playing favorites. Liquidity has dried up, and banks are now looking for partners who are going to invest in the relationship with that bank, meaning carry deposits there before they decide to give them loans. That's been in the headlines even as of last week. What's your take on that?
Oh, I think it no doubt is happening. And I think that the scarier thing that's also driving that is the consolidation. The bigger the bank, the bigger the customer, right? The less risk averse they're going to get as the bank gets bigger. And this is one of the reasons, and thanks for the question, because I'm going to take you down a little bit of history to get you to the answer to that. If you look at America, it's a fairly unique banking ecosphere. There was a point in time that America had 35,000 banks. And then just before the Depression, there was a bank holiday where they shut down the banks and over 10,000 of them disappeared. And then again in 2007, there was another major crash that brought it down. But even today, there's 4,700 independent small community banks or banks across the United States, and then another 8, 10, 12 big banks, and then the regional banks. There's countries out there that literally only have 4 banks. So one of the things and one of the challenges in the banking that we're seeing, and a struggle we've seen played out in this, is that the Treasury Department in Washington, D.C., the feds, they are driven by these big corporations, and they would like consolidation. The big banks, J.P. Morgan and Wells Fargo and Bank of America and UBS, they'd like to see it consolidated down to 5 or 6 banks, and then they would control everything. The interesting thing is the FDIC is the one group entity that believes that competition is the best thing for the communities and the best thing for the banking. And I always struggled until I started getting into trying to purchase a bank and stuff. I struggled with the $250,000 cap on the FDIC insurance level till I started to understand it. And after I sat with them, their whole concept is they believe that by having only that $250,000 cap, that they're encouraging competition and that money gets spread across a lot more smaller banks. And then that way, if there's ever a crash or something that happens to a small bank, the FDIC and the insurance is there to cover it. The challenge we face today is the truth of the matter is the Fed stepped in and helped out on the SVB situation. But if JP Morgan crashed, the Fed couldn't cover it. Any one of the top 15, if they went down, they couldn't even cover it. And the problem with it, back to your original question, is the bias and the favoritism is already there. If you're a big corporate entity and you've got a lot of money that you can deposit with JP Morgan, you're going to have access to their loan officers, their people, and you've got that one-on-one contact, and you're going to be able to borrow money pretty much for things that don't even make sense. They seem to let that happen. But what's going to happen is as that consolidation happens, and the reason for the smaller banks is, can somebody sitting in an office in Wall Street or in downtown New York really make an educated decision on loaning money for a home in the Houston market or in the Austin market, or in like my case, I'm in Leander, which is a suburb. Are they really educated well enough to know, hey, Leander's actually the up and coming in the better part of that deal, and so this home may seem like it's priced a little bit higher. Do I want to do that loan, or could I do that loan? They can't possibly know that because they're too far removed from it. So the bias is happening right now, something terrible. Did that address or answer your question?
Yeah, agreed. I definitely wanted to hear your take and just hear you speak on that point. I know you're a very well-versed historian on this. So,
well, and we'll talk about I'll get there a little bit more. We'll go a little deeper, but I thought I'd touch a little bit because the title of this was, what is the state of the banking industry today? And that's what you guys talked about. If you look at it right now and you remove the media from the situation, the banking industry, with the exception of a couple of institutes that were just absolutely poorly managed, is really in very good position. The trouble and the challenge in our banking community, and the term that the banking and the smart people use, is stress. They'll tell you here that banks are under a lot of stress right now. The truth of the matter is these banks aren't in trouble because of stress from capital. The banks are pretty well capitalized. Most of them have money because of the way it's put out, nor is it a credit problem. The biggest problem in most of our banks today right now is liquidity. And the challenge within that, and what happened, and we can actually talk through a little bit of the SVB deal and how it went down because it was such a great example of it. Within the banking world, and one of the things that I learned as I started doing this that took me a little while to get my head wrapped around, but when you think about it, it makes sense. In the banking world, they look at a deposit on their ledger sheet as a liability. And that kind of took me back. I'm thinking, wait a minute, I just gave you $100,000 or $50,000 I put in there. Why is that a liability? But when a bank takes a deposit, first and foremost, they now have to secure that deposit. And then they have to pay some sort of interest on that money, or they used to. And albeit lately it hasn't been very much, but now that's changed. Right now, you should be able to get some pretty decent interest on a good money market account or a savings account. And they have to secure and they have to service that money. A bank, on the other hand, looks on their balance sheet as a loan, as an asset. And in my mind, I think of a loan as being risk until I got into the banking world. But banks make money by charging interest and loaning you money. So with most of the banks, what they try to do and what the regulators want to see is they want to see a pretty decent balance between your deposits and then your lending. And then the wild card in that is liquidity. So they have a formula, and what that formula basically is how much liquid capital do you have, and then what's your depository rate, and you do a multiple of that, and then that tells them how much money you can lend out. And they want that to be pretty balanced so that if you do write bad loans, or you do have a couple bad loans go bad, you've balanced it either with liquid capital or you've balanced it with a deposit. And what happened in the SVB situation was simply bad banking. It wasn't that they didn't have the capital. SVB was this regional bank, mid-tier bank. They were in their billions of dollars. They played primarily with startups, these high-level startups, and these startups were bringing in big VC money. They were bringing in some foreign money from countries and whatnot, but these were the hot things like Tesla and things that people were getting behind. So all of a sudden you had a company and they would get $20 million or they'd get $30 million from a VC and they'd take it down to their bank and they deposited it into the bank. And SVB was the go-to bank on this situation. And all of a sudden they had this huge influx of capital. So they've got these deposits. And one of the tools that a traditional bank uses in that scenario is to offset that. If you don't have the appetite for the loans at that point in time to lend that money out and gain the interest back to cover the cost of servicing that money, banks would buy bonds. And SVB was a bank that had a risk compliance officer that had quit. They were operating for almost a year without any risk compliance officer at all. How that happened, I still don't know. And they all of a sudden saw this huge influx of money. And to make it simple, we'll just say $100 million. It was more than that. You can look up and see exactly what it is. They ended up with this pool of $100 million. And at that point in time, Fed interest rate was basically zero. So a 6-month bond, and the number was roughly 2.6, I think it was, but don't hold me exactly that number, but a 6-month bond was paying like 0.26% interest. If you looked at a 5-year bond, it was paying 0.54% interest. And if you looked at a 10-year bond, it was paying like 0.97 or maybe 1.11 interest. And somebody at SVB sat down with this pool of money and said, well, look, if I'm going to put $100 million over there, I might as well make 1%. And they bought 10-year bonds. But they didn't have a risk manager looking at this and saying, but wait a minute, what are the needs in 1 year, 2 year, and 5 year of our customers for capital? So they parked this $100 million into these 10-year bonds. So now that money is locked up. They weren't broke. The money wasn't gone, but they weren't liquid. They didn't have access to it. And some of their clients came to them because they were startups and had a big appetite for capital. And they said, hey, we need our money. A weird phenomenon had happened at the same time. And that was because of COVID, our government dumped 6.5 trillion into the markets in fiat money or just printed money to try to keep the economy afloat, to take care of people who are out of jobs, and created inflation. And the primary tool that the feds use to stop inflation is they raise the interest rates. So we had an unprecedented run of 500 basis points on the interest rates in a very short period of time to try to stop the inflation. And you had a bank that was sitting there with $100 million in bonds that were only paying 1%. And now all of a sudden money had went up 500 basis points or 5%. And they had a customer that wanted their money. The money was there, but the difference was the bank was going to have to pay a penalty to take that money out of that bond, or they were going to have to borrow money from the Fed to lend to their customer that was going to lose it for them anyway. And that was one of the reasons that once it happened and they went insolvent, rather than being the run on the bank, there was suitors ready to stand there and buy it. They were ready to buy it tomorrow because none of those loans or none of that money was really at risk. The capital was there. They just didn't have the liquidity to get through it. And it literally was, it was absolutely the perfect, it's a wonderful life scenario. And what George was trying to tell them. What's that?
Just the perfect storm of events that led to that collapse, right? And
Absolutely.
Is this that concept of the unrealized losses at that point?
Absolutely. The unrealized losses that they were talking about was they had $100 million worth of bonds that they bought at 1%, that was paying them 1%. Today, that bond was paying 5%. So there would have been a penalty in between it. The reality of it is, if that bank would have done nothing but sat there for the 10 years, that $100 million would have actually been there, not only with $100 million, but a 1% return, which on $100 million is a substantial amount of money. And it was like George was telling all the people standing there, your money's here. It's in Mr. Smith's house over here. And it's over there. The money was there. That wasn't the reason that it crashed. And we've got a media now, for whatever reason, that just loves a good crisis. Never let a good crisis going deal. So they started talking about the insolvency of banks, and they were literally creating a self-fulfilled philosophy, because the only thing that was going to hurt, were there a lot of banks, or are there a lot of banks out there that their balance sheet is pretty close when you look at the loans that they have versus the deposits that they have? And what most banks have done is they would have taken that 100 million. A good risk officer would have taken that 100 million, and they would have put 40 million of it into 6 months bonds, even though it was only paying 0.2%, because they say, look, in the next year, we need access to this money. And then they would have put some of it in a 5-year bond, and then they would have put some of it on a 10-year bond, so that they could have spread the wealth and met it across the deal. But they didn't do that. And then
question at that point, though, in their situation, cat's out of the bag. They have this demand for capital from their investors. How, I think you've talked about this, how would your bank concept deal with something like, obviously not get into that situation is the first step, spread your risk, your short-term and your long-term risk. But in that situation, is there a way that you get access to liquidity if you needed it?
Yeah, and that's one of the things that we've had to work real hard with the regulators about, that's really unique about our model. Most of your banks, the traditional bank model right now is you have your community banks, and those are what in the industry they're referred to as generational banks. The family owns them, and they pass them down, and they own it. What's interesting in that is even like the CEOs and the CFOs of those banks, they don't even get stock or ownership in those banks. They get what's called phantom stock, and it's golden handcuffs that they use. So most bankers of a small bank, their real payday, they do real well. They make money, good money going through their life and stuff, but their real money is in their retirement when they cash out their phantom stock, which is basically the owners of the bank just giving them money for stock that they should have had. The second way that people do it, the regional banks, is they start out small, and then when they get big enough, what they'll do is they'll do an IPO, and then it just goes out into the market, and you can buy stock in it, and you're a shareholder in the bank, but you go out and you buy small pieces of stock. You don't really have any influence or anything over the bank. What we're going to be able to do, and what's going to make us a little bit unique, is twofold. The model that we're proposing right now is the bank that we're looking at buying is a small community bank in Iowa. The acquisition price of that bank will be around $6 million when we're all said and done with it. We intend to raise $30 million on the deal, and what will happen is $6 million of the $30 million will go to the purchase of the actual bank, and then we've allocated roughly $3 million to replace the traditional branch model of banks, and we can talk a little bit about that and why that's ineffective and why it doesn't work, and we can replace it with software. So we'll spend about $3 million to $4 million on software, so you have $10 million. That will take, at this point in time, a little small institute bank, and all of a sudden it will be sitting there with $20 million of liquidity at a time when interest rates are high, which are good for banks, number one, and then number two, at a time when a lot of other banks don't have liquidity. There is a lot of banks, they're not really in trouble. They don't necessarily need to close, but they're going to be stagnant in their size, their ability to grow and loan. They need to just float along as they are right now and service the loans that they have. This bank will be unique in the fact that it will be heavily with liquid. Also, because of that model, what we intend to do is, because we're catering to physicians, and right now, most of my page, most of what we talk about is orthopedics, and that's primarily only because that's what I knew. That's what my Rolodex was and the people that were involved. We're talking to family practice doctors. We're talking to cardiologists. Ultimately, I want to be able to expand and do all of it. But with this model, what will happen is, let's say that we do the initial $30 million raise, and we have the $20 million in liquid capital. The federal government and the formula will allow you to lend out 11 times that. But we've put into our business plan, we'll only go 8. We'll be able to lend out $160 million against that 20 million. And make this bank extremely profitable, and we still have a good cushion in there. But if we hit that wall, and we're lended out at 160 million, and we have demand, what happens is, if another group of physicians, and now that they're consolidating, and I'll use orthopedics only because, like I said, that's what I'm most familiar with. If Tennessee Orthopedic Association decides that they want to start banking with us and they want to come in, there's about 106 orthopedic surgeons. Instead of just taking their deposits, we're going to allow them to buy in. You can be a partner in it, a share. You can buy shares in it just like you did the ASC. So you gain two things at once. You're going to gain the deposits, which is part of the balance for lending money to those people. You're going to get another influx of liquidity. 100 surgeons, if they come in at 15,000 a piece, you're looking at another 1.5 million in liquidity that you can lend out at 8.5 times that. So they're basically self-funding their loans. And now you've got a new group that has a demand for loans. So it becomes a self-fulfilling or self-growing entity as it goes. And we're starting out with such a small number. We're looking at starting with 600 doctors in the first go around. In the United States, there's 26,000 orthopedic surgeons alone.
So I got to ask, since I know you've looked at Rick Rule's content, and he's done this similar model before about 20 years ago with Everbank, and it's now looking to launch Battle Bank. And their angle is moving away from the fractional reserve lending model, right? It's trying to back everything by gold.
Sure.
What is your thoughts on that? What are the inherent risks of the fractional reserve lending model? Isn't that kind of why a lot of these banks are in some of these challenging times? Is it better to have sound money, quote unquote?
Well, yeah. I think his bigger challenge with it and stuff is, and if you go back and you look at what happened in banking and stuff, where we really had the big problem when banking first hit the end was when we went away from the gold standard. Regulators came in and literally outlawed the owning of gold in the United States. So one of his I love what he's trying to do. He's trying to get us back to a basis where the money is tied or backed by something that's tangible by putting the gold and stuff in it. But it can be very volatile based purely upon the regulatory decision of what the federal government wants to do. I think the more important thing is, and by the way, I owe it to you and to your podcast stuff. I wished I'd have known about Rick before I started my journey. I thought that I was really unique. And after you pointed me towards him in the Wiggins session, I'm thinking, my goodness, this guy is given the best sales pitch for what I'm trying to do that I've ever seen. His difference is he's focusing on that gold, the precious metals. And then he's also focusing on, if you look at where he's going with Battle Bank, they're trying to do it in foreign currency as well. So the bank is also looking at allowing people to invest in, or that bank to invest in and hold foreign currency, which has been an interesting model. If you talk to a lot of the economists and stuff, they think that the world banking and stuff will be more stable if instead of it being based purely on the US dollar, would be a banking industry globally that was based basically on 3 different currencies. So a lot of the really smart people say, look, what we ought to do is we ought to have the dollar, the euro, and maybe the yuan from China. That one makes me a little bit nervous because they get up every morning and tell us what their money's worth. They would have to come into the deal. But there's a lot of sense to banking it, having a more stable deal. And then that way, if there's real bad inflation or trouble with the American dollar and whatnot, then the world banking doesn't take as big a hit across the scenario. I like what Rick's doing. It just boggles my mind. It's just he's done it and focused on a different sector. I think that the interesting thing that ties the two of us together is that gold will always have some value, right? By tying it into precious metals and stuff like that, the gold is a pretty good standard to have it to. What we've done is we've tied it to doctors. And what's interesting is when you look at it traditionally in the United States, the lowest borrower of money to default in the United States is a physician. Physicians just traditionally, unlike a lot of other stuff, just don't default because you guys, for the most part, work very hard. If you get behind, you can roll up your sleeves and work a few more hours to pay it off. I think probably more importantly, your whole practice and everything is built on trust. We've gotten to the point where so many of these contractors and stuff around here anymore, it used to be when I was a kid, if you were a contractor or any business and you declared bankruptcy, you were more or less ostracized from ever doing business. People didn't kick you to the curb or spit on you when you're walking down the street, but they also shunned and weren't going to do business with you. Today, there's industries like contracting stuff. They wear bankruptcies like a badge. Some of these deals have gone through 4 or 5 bankruptcies. And I think that's a luxury that physicians don't have, because I'm not sure that people are comfortable if they lose that trust aspect of a physician that they're going to trust them with their health.
Yeah. Also, physicians were very, we have our pride in terms of wanted to always do the best at all times. And that's been used against us sometimes, even with negotiations and things like that, because they know you have that integrity, right? That you're not going to just leave the client. You're not just going to walk away. And so look, I also wanted, go ahead.
No, go ahead. Let me throw one thing back and then I'll take a question. Look at the burdens that they've placed on physicians that don't belong there. The regulations says that if your Medicare copayment from Mrs. Smith is $15, okay? Mrs. Smith comes to see you, and most physicians that see Mrs. Smith, if they realize that she's this close to eating cat food out of the tin, would be more than happy to waive the $15 to see that patient. Right. But the federal government comes in and says, no, that could be considered an inducement for a referral. So the same people that say that you guys are traditionally bad at business, if you ask a hospital or you ask a government entity how much it costs to generate an invoice, they will tell you, they'll give you a number between $12 and $17 to generate an invoice. The same government now tells you to prove that you couldn't collect $15 from Mrs. Smith, you have to invoice her 3 times. You have to spend $51 to prove that you can't collect 15. But even worse, in the public's eye, now Mrs. Smith goes home and she thinks, I love Dr. Ozoude to death. He's been really good to me and stuff, but I've also seen how he lives. I don't know why he's chasing me for $15. They have no concept and understand that you're facing a $10,000 fine and possible loss of your license when you would have gladly waived that $15.
Yeah, and patient doesn't even know that it's not the physician that wanted to collect that $15, that it has to do with the regulations. But I think we just have to keep pushing in the other direction. One thing I wanted to comment on, you mentioning about the efforts in the government trying to consolidate the bank, right? So yeah. I'm actually Canadian. So in Canada, there's only few banks, at least the popular ones. And in every single province, you can only maybe 5. So I wonder if that's just because it's like a smaller country with 30 million population, they just haven't broken through. So when I came to America, I found it to be refreshing, right? That I would just go down the streets and there's different banks. Because if you apply to 5 banks and they reject you, that's it.
Right.
You know?
And it makes the government easier to track everything that you do. And times they can freeze accounts and everything else. What made America so unique truly was the farmer, right? Most of these generational banks and stuff were ag banks. What made America such a unique country versus Canada and a lot of the ones in Europe and everything else was, my town that I grew up in was a perfect example. It's a small town of about 8,000 people in the middle of Iowa. When I grew up, there was probably 27 farmers in that town. The farmers needed money for tractors, for plows, for combines, for the purchase of the land, and then even for the seeds. And they tended to borrow heavy in the spring when they needed their seeds and fertilizers and stuff. And then they'd use the money during the summer, and then they'd have harvest in the fall. And then the money would come back and it would float through the bank. Because there was that base of those farmers, you could have a small community bank, and they were really built on the backs of lending the money for that land because they understood it. They understood the need for the tractor, for the combine, for the different pieces. And then because it was there, it was now able to service the little retail shops and the individual people with their checking accounts and their savings accounts. But without that big ag business that was sitting behind it, that bank wouldn't have been able to survive in that small community. And now one of the things that we've seen too is farms have consolidated. So in my community, I think we're down to 4. I think in Hamilton County, Iowa, it's down to 4 large farmers. Fortunately, the bank was established enough that they could stay in place. But it was those types of little entities that allowed America to just have these, like I said, at one point in time, it was 35,000 banks in the United States. We're at about 4,700. And there's going to be probably a little bit of consolidation, but it's in our best interest to be, the more banks that are out there, the better the competition, the better off we will be.
I'd like to ask, in relation to that question, what you foresee as a regulatory headwind. As these banks consolidate, they'll be in better position to make it harder for other banks to come into the market and compete. What do you foresee the whole banking industry kind of setting up as a headwind for your project?
Yeah, no, that's a great question. It's interesting is the FDIC has become a little bit of our friend, right? Because like I said, there's that tug of war going in there. The FDIC lives in fear of the fact that if you get these banks too mega, if JP Morgan were to go down tomorrow, FDIC couldn't even fulfill the $250,000 minimum on that, much less bail out the entire bank. So they've become our friend in the headway. I think that there's also always the first knee jerk, roughly after SVB, $119 billion of deposits moved from what they call the small and mid-tiered banks into the large banks. And it's crazy, as you pointed out, and if you listen to Rick Rule, he talks about it, it's absolutely insane because it's insured for the same amount at those bigger banks, but the perception of security drove these people to move their money from a smaller bank that might have been paying them better interest, but at the very least was giving them better service because they knew them. And from a scare or a security standpoint, put it into a big bank that doesn't care about them at all and isn't paying them anything. I got my statement the other day and it made me so mad. I bank at 3 banks. I have some property. So I have a national bank with Bank of America. I have a regional bank, Frost, which is the only bank I actually know somebody at, where I can go down and talk to them and I like them. And then I have money in a credit union. I'm still not sure why. I got to rethink that. And I opened my statement from Bank of America today. They're charging me $16 a month for my business checking account. And I'm thinking, why am I there? And that's those kind of headwinds. What will happen is the knee jerk of this 119 billion goes because the media put this out and people are scared. But then people are getting tired. And I think we're seeing it with Amazon. I think we're seeing it with a lot of other ones. People start to get tired of the big one and they go, wait a minute, I want to come back to something that's got my best interest or that the service is a little bit better. So I think that will help us. The other regulatory headwind that we're really excited about, and for me, it's a personal thing, and it's been something I want to drive for this as well, too. We talked about Mrs. Smith and her $15 copay. The other thing that's happened in America is we have crossed a chasm with insurance to where my wife and I, we're such a house divided. She's a nurse. Through her work, she has Blue Cross Blue Shield insurance. I'm cash pay. I opted out. I looked at what it was costing out of her paycheck every single month for her to just have me on her policy. And that was to have a $5,000 deductible with an $8,000 out-of-pocket expense. I don't spend, and there's a guy, if you guys don't follow him on LinkedIn, there's a guy out there named Preston Alexander, who's a young guy that's starting to put some data and stuff out. Follow him on LinkedIn and look at some of the data that he's put out. And one of the things that he showed is the 1% of America spends $130,000 a year in healthcare. So that's obviously your cancer patients and people that have some real made catastrophic event. And that's only 1%. 5% of the American public spends $61,000 a year. The rest of the American public spends $524 a year in healthcare after their premiums, if you don't include their premiums. Most of us just don't use it and stuff. And insurance has now crossed that chasm where you can't, my wife is of the mindset that you can't afford to not have insurance. And I call that the Las Vegas model. That's believing that you're going to go to Vegas and win, but Vegas isn't there because they're losing money, nor are the insurance companies. I believe we've crossed the chasm that you can't afford to have insurance because by the time they took out for me to be added on to my wife's policy alone was going to add almost $700 a month that they were going to withhold out of her check to get me an $8,000 premium. We're out of pocket over $15,000 before my insurance even kicks in. And that's if they don't deny the claim or whatever it is that you looked at. One of the things that we've proposed and one of the interesting regulations within the banking that they didn't know how we were going to solve, because our model is getting rid of the branches and stuff with software, and we're going to cut our overhead by having one charter in the Midwest, probably in Iowa. And because physicians and stuff tend to bank digitally anyway, your money moves on the wires. We don't need all these branches. We can do it with software. And one of their concerns is banks have to have or need what's called a CRA, which is the Community Reinvestment Act. And so a bank has to invest or do a certain amount of loans that invest back into the community. And what most banks do is low-income housing. That's the way that they'll satisfy a lot of their CRAs within the community. And what we've proposed to the FDIC is, and we got to work through the details with them, but they're embracing it. They're very excited about it. Is all of you doctors know that, Mrs. Smith, the patients in your communities that are really good people and good patients, but just literally can't afford health care. And what we're proposing is for our CRAs is that physicians will be able to identify those types of patients that can't afford their deductible or can't afford care at all or don't have insurance. And they can bring that to the bank. And then what the bank can do is we'll push that up. And if it meets certain criteria, we'll have to work with the FDIC to define that criteria. If they meet it, what will happen is the bank will absorb that loss. So we'll be able to take certain patients and stuff and see to it that they get provided care. The physician, or if it's a surgery and it needs to have it in a hospital, they'll still get paid because they'll get paid from the bank. And then we take the write-off on the other side. And I hope we can also do that then to work with physicians. And I know physicians will work with us. ASCs will, after they get hospitals, to also discount that care to say, hey, if we're going to provide care to an indigent or somebody that can't afford it, will you give us a discount? So those are some of the regulatory headwinds that I think that will be good for it. And I think the other thing that will change is, I don't know that it would definitely fall under regulatory. The traditional bank model, and our friend Rick Rule talks about this a lot, is a motor bank, right? In Austin, Texas, or a branch bank. In Austin, Texas, Wells Fargo comes in, they go downtown Austin. Then as their customers move out to Dripping Springs and their wealth goes, they have to put a motor bank out there. A motor bank's expensive. They have the property, they have the land, and they have a minimum of 5 FTEs, and you've got security and everything else you got to do. And then the population moves to Round Rock, Texas, and then it moves to Pflugerville and to Leander. So the bank has this footprint of all these FTEs and everything else to grow. Physicians are unique in the fact that when you get paid by an insurance company or you get paid by Medicare, it's not done with cash. You bill a CPT code or an ICD-10 code. It gets approved or denied, and then that money electronically moves into a lockbox, and you check it, and then it digitally gets swiped in. So we don't need those motor banks. We can do it with software. And what we intend to do with the software, it's going to be different too, is like right now, this is my biggest banking tool. I take a picture of my check, and I was talking about with my brother until I went and looked at one of these banks we were looking to purchase and met with them. I walked in and I thought, man, I can't remember the last time I was physically in a bank. But because of that, I also don't know anybody. With the software that we're putting together right now with some consultants and stuff, we'll have the basic being able to take a picture and stuff. But because all of our people are focused on you and you're our customers, what we'll have is software that, just like we're sitting here interacting and talking now, we'll have tellers that will be assigned to each of your guys' practices and each of our customers' practices that know them. If you have a complex transaction, like right now, if I get a big check, I have to take a picture of that big check and I deposit it into one account. And then I have to wait for them to clear it, which is foolish. They know whether it cleared. They electronically clear these things right now. They're just operating on our money for 3 to 5 days. Then I have to log on and I have to move that money where I'm going. We'll be able to offer services where you'll just touch teller. And just like we're sitting here talking right now, a teller is going to come on your screen that knows you. You've interacted with them just like you walked into a branch bank. And you'll be able to say, hey, I've got a sweep of money coming in from Aetna or from Blue Cross Blue Shield. It's $50,000. It's going to hit on this day. I need 10,200 of it to go into my clinic account. I need 2,000 of it to go here. I can go to a vendor there. They say, okay, perfect. They're going to write up a deposit slip just like you walked into the store, and you can just reach up on the screen and sign it, and then they go done, and they'll just move the money for you. And that will be the same with loan officers. You'll be able to interact with the loan officer that knows your practice, that if you're wanting to buy something as simple as a car and Lexus is offering 3.99% interest, you'll be able to talk to a banker that knows you, and they're not going to say, okay, I need 3 years of your tax returns, and I need the equity deal and the deed, a copy of the deed for the building that you own, on these other things. They're going to know you. They're going to get on there and go, hey, yeah, look, we can beat that rate. The other good side of that is when these car manufacturers and people like that are offering 0%, it's going to work both ways, because they know you. They're going to go, if Lexus is going to loan you the money for 0, we'll loan you. You bank with us, we'll loan it to you. But if we could use that $80,000 or $100,000 to loan for your ultrasound for the other deal, 8%, you're going to make more money. Wouldn't we be better off with you borrowing that money from Lexus zero, and then using that money to fund something else in your deals. Having ownership drives both sides of the good practice of any entity, much less a bank. And I talked an awful lot here, and
we've got some questions.
I'm wide open for questions, and I can stay here as long as people want to talk. So
no worries. This is just a huge educational event here, so we're loving it. We have a question in the chat here. What's to keep physicians from taking over the bank since they have equity in it, and it is predominantly physicians based?
Nothing. I had an interesting conversation with somebody the other day, and they said something about my board seat and people on there. The whole thing about medicine and what we've done has always been a best of the best class. So the truth of the matter is if somebody can come along and they're better than I am as a board, you guys will get a vote that, and they can be on the board and they can run it. The concept of this is, I don't think you see, like in the ASC, and even when we go into the medical office buildings and stuff like that, most doctors have a passion for what they do, and that's what makes them so good, and that is they want to treat patients. They really don't want to necessarily run the day in and day out of the business. So in the surgery center, we don't see a surgeon running the scheduling boards, and we don't see the surgeon doing all that other day-to-day deal. We want to structure this, and part of what we've done is there's an ESOP involved in this. We want the banking people that are bankers we hire, they're going to be owners just like us as well. And by allowing them to actually have real ownership instead of fan ownership, we'll get the best of the CEOs, the CFOs, and the people like that. But just like any other company, there probably really isn't anything other than just the votes in there. And the more people that invest in this, the less chance of one rogue individual or one group taking complete control. And that was something else when we looked at this. What we did when we structured the investment in this, we put two caps on it. We put a bottom. We wanted the minimum investment to be enough that residents, people fresh out of their residence, and fellows, people in the industry that work in your office and stuff, your office manager and CEOs can invest in. So there's a low invest in the bottom. And then we also capped the top of it. It was originally at 90,000 per individual. It's now capped at 150. And that was to keep it from being, I actually had a couple of doctors that had done well and had sold a couple of patents and whatnot that wanted to write $5 million checks. That just doesn't happen. No physician, one of the competitive things that's been driven into physicians is the surgery center down the street that they don't own, that somebody else owns, could be so much better place to work at than the hospital. But if they don't have ownership in it, or if that person owns an unfair amount of it, they're not going to take their patients to that surgery center. So we put a cap into there to keep it. And part of what we hope is just the spread of the number. 600 doctors investing in it shouldn't keep it from one or two doctors being able to go rogue and take advantage of anything.
So there was actually another question came in on our chat that's a little related to this point you're talking about. The question was, will the non-physician partners invest capital as well? I think the skin in the game side, a question from your side and your team.
Yeah, absolutely. So right now, the funding in all this, there was two original founders, myself, I'm from industry, and then my partner in it is an orthopedic surgeon. And then we're carrying all the risk. The money that comes in right now goes into an escrow account. We don't get access to that money until the bank's actually up and running, or until we own the bank, and then we're turning a profit. That board right now is 3 doctors and 3 people from industry that are all real good at business and do what they do. When we hire the CEO, they'll be the 7th to make that an odd person board. We may end up expanding that as it comes on. If there's some investors and doctors that have good business deal and want to participate, we could expand it. There's a point where a board gets so big it's unmanageable, so we wouldn't go over that, but there's a number. The way that this is also structured is the investment is actually in what's called a holding company, and that's the name Bancorp. If you look at it, we're First Physicians Bank, or Physicians First Bancorp, not bank. The investment, we own a Bancorp, and there's a reason for that. The Bancorp is an umbrella and an entity that can do a lot of other verticals, and this is something that's taken us outside of the Stark. So the holding company, once it's up and formed, it can actually become an insurance broker, and it can broker insurance. It can be a pathway to self-insurance. There's a whole lot of entities, property and casualty insurance, employee health insurance, a lot of these things that can fall underneath the umbrella of the holding company. And that's the board I just described to you. Once the money's there, the holding company buys the bank, and the holding company owns 100% of the stock of the bank. The bank will have its own board, and that board is financial people. So there'll be a 5-person or 4-person board, 5 including the CEO, and the CEO of the bank will bridge the two. So the CEO of the bank will sit on the board of the actual bank and work with the financial people to regulate and manage the bank to make sure that we're not making decisions that bring a bank down or take it underground or take it underwater. And the commonality between the two will be the CEO will sit on the two of them. And then we're also structured that we can have advisory panels feed up in there. And because we're outside of Stark, if we do bring people on in an advisory role, they can be paid. And it's not a Stark incidents and stuff. And we do foresee as we get bigger, because each of your guys' needs and stuff and insurances are different. The way you deal with Blue Cross Blue Shield in Michigan is different than in Florida, and is different in New Mexico. And there's different differences in the geographies and stuff. Once this is up and running, we're structured such that we can have advisory panels. And we see ultimately at some point in time, if we get big enough, that there'd probably be 5. There'd be an advisory panel from the Northeast, an advisory panel from the Southeast, and then a swath through central of the United States, and then the Northwest and the Southwest. And those will get added on as we grow and as we fill those
As we talked about some of those verticals, there's actually another question in the chat that's related to that. The concern is that funding the high deductible sounds like care credit, and they're not sure that it's a great idea heading into a slowdown due to the possibility of defaults. What's your take on that?
Sure. So I think there's twofold to that. Care credit does a lot of these loans at 20%, which is just absolutely insane. BHG was out doing these loans as well too, and they're now a $1.7 billion entity. One of the values in this industry and stuff and doing those types of loans is most of you physicians have a pretty good relationship and a pretty good touch point with your patients and know who the better risks are versus the other. So the software will be set up to where it will be a tablet and they can answer a couple of questions. There's a few things that will trigger almost an automatic. If you've got a credit score of 690 or above, that's a pretty easy one, because you're only talking about a $5,000 deductible loan in most of these cases. The other real value to that deductible loan is if you look at it, a lot of the orthopedic surgeons, more so than the general practice, the other surgeons, in January, February, and March, literally become pain management doctors for their patients. All these orthopedic guys see these patients in January, February, March that they know need a procedure, whether it be an ACL or whether it be a total hip or whether it be a shoulder. And when they sit them down with their schedule, they say, look, you're going to have to bring $4,700 to the table. And they go, whoa, wait a minute, I have insurance. They say, but you haven't met your deductible. What's really interesting about that is they then leave that physician's office. And what do? They go out and they spend healthcare dollars. They go spend money for physical therapy. They say, okay, we'll try physical therapy. So death by 1,000 paper cuts. They spend money for physical therapy. We know that's not going to work when it's bone on bone, but they go do it. They spend money for imaging. They spend money for labs. They spend money for pharmaceuticals in the hopes that by October, November, December, they've met that $5,000 deductible. Then they come back and they see you, and then you actually get to treat them and they actually get the care that they need. By accelerating that and moving that forward, you do 3 things actually. You make the patients aware of the spend. You get them the care at the time that they need it. So if you take a total joint scenario, if it's a patient that needed a total hip and their deductible was $5,000, you do the procedure in January. The patient gets the care when they need it. The physician in the ASC or the hospital get paid at that time. Now, when they're done, because they've met their deductible, that patient doesn't have to go spend dollars with the PT. The PT is covered because they've already met their deductible. So rather than them paying that money to the physical therapy department, they're paying it back to you, and you're making a little bit of interest on it. We intend to do those loans at about 8 or 10%. They don't have to pay for the pharmaceuticals, and they don't have to pay for those other things. And then a certain percentage of those, because of the way that we're structured as a bank and stuff, we hope some of those that we lose, and you'll lose some of them. That's just part of banking. There's some up and some down. Those are pretty small numbered ones. And we believe we'll be able to write off a percentage of those again as part of our Community Reinvestment Act, to be able to say that we took that and that we provided a service to the community by getting somebody care that didn't need it. And then you'll also balance those out with, for all the patient loans, and I think they're good loans. I think a third byproduct of that, and we'll balance it with equipment loans, but a third byproduct of that is one of the biggest problems we have in America today is that the insurance companies and the hospitals keep all the American public focused on the cost of healthcare. And then they play games with what the difference is between billed charges and collected charges. So they artificially inflate the actual cost of healthcare. So they have everybody living in fear of a catastrophic event. But just like I alluded to earlier, Vegas isn't there because more people go out there and win than lose. United Healthcare didn't float $200 billion last year. They didn't make $20 billion in the last quarter because more people had catastrophic events than not. And what this does is, by doing this on the front end and getting them involved, these patients now will start to understand the spend of healthcare. And this should be a transition to a direct pay, or being able to negotiate. The bank can ultimately now coalesce the power of having physicians across the United States and be able to work with employers and start to work with a direct pay model and stuff. And one of the wins I think that's changing in this that you asked me about before is a lot of these big corporate or even mid-tier manufacturers or companies are realizing that insurance companies don't provide a value anymore. They don't cover risk anymore. They manage healthcare dollars. And what they do is they take a percentage, of the spend, and they make 6 or 8%, and all they're doing is managing their dollars. So the better the educated the public is, and the better educated the consumer, being the employers and stuff, are, the more chance there is to move them to understand the spend and to use the bank as a tool to possibly move into more of a direct care world and HSAs. And HSA should be a wonderful thing for a bank because those are long-term stable deposits and they're good for physicians.
A lot of great points there. Bio, anything else?
He did a very good job of going through most of the things I have, because I'm particularly interested in the financial health, the regulatory compliance. I think he covered that. The liquidity, basically, he covered that by making sure that they're basically well capitalized and they don't lend out money. So it's the money at the bank. The market conditions, I have that also in terms of how the interest rate impact the profitability and stability of the banks. So I think you touched about that a little bit, but are we at a major risk right now because of the interest rate? And what's your thoughts about the interest rate actually in the next 12 months?
The interest rates are good for us. The fact of the matter is, sometimes, and it's not been very often in my life, that time helped a deal for me. Had we have closed this bank down a year ago when interest rates were really low, and then the bank that we purchased had to sit through the rapid rate of those 500 basis points, or the 5%, it would have put more stress on our capital, more stress on our bank. Right now is absolutely the best time to come into a bank, because I think that we still have some inflation coming down the road. They're playing a lot of games with the numbers and everything else. I think you're going to see the Fed probably raise at least twice more. I think they're going to have to do it at least once more, just because I think, like right now, a lot of times when you hear them talk about inflation coming to where they like it, they're trying to get it to that 2% or 2.5%. And they're now touting numbers of 3.9 or 4, but they're saying that they now call it core inflation, and they take out food and energy. My goodness, if you take gas and you take food out of the cost of living to get to the 4%, you're just killing it. And I've got a daughter in college, and she's really a good one. She doesn't go out to eat much. She cooks. Her bill has been pretty much $90 a week she spends on food at the grocery store. We're at 126 because of that inflation. And they just take that out of it when they report it to us. So the really good news about the inflation is, I think that the interest is here higher for longer. I think that's just going to be a reality because we've got some problems and stuff in there. The good news is the bank is dealing with that because they'll have liquid that comes in front end. And what really hurt a lot of these other banks is, if you look at the average loan that a bank runs is around 10 years. It's anywhere from 6 to 7, and especially if you factor in mortgages that are 30 years. They lent money when money was at 0%. So a lot of these banks have these 3-4% loans sitting out there, right? And on the other side of their balance sheet, the Fed increased that deal. So now they're going to have to start paying out more on their deposits. And deposits are quick. If I'm in a bank, and if you're in a bank right now and you've got a bank that's not paying you interest on your deposits or paying you less than 1%, I'd tell you to go start shopping your deposits, move your deposit somewhere else. Well, a person can move their deposit really easy, but loans stick around for a long time. And one of the biggest things that's hurting our housing market and stuff right now is people are marooned into their loans. If you're sitting there with a 3% loan, you're not going to get out anytime soon because you can't borrow money under 7 or 8%. So having a bank that comes in when that money is already there and already high allows us to do those loans and have a better balance on our deposits and our loans on the top end of the deal. And then eventually what will happen is, I think the Fed will raise the rate at least one more 25 basis points just to try to get inflation. I think we're seeing it curve up a little bit. Then I think you'll see they'll probably have to do 1 or 2 more. And those will basically be loss leaders because they know that what they're going to need to then do is lower the rate to spur the economy because we're going to go into a stagflation type of a deal. So I think you'll see at least 1 more and probably 3 more 25 basis point raises, so higher interest for longer. Then once they do those, then they'll start to cut the interest down. And the nice thing about our bank, because you're in it later on, we're going to make money on the way back down too, because what you'll do is you'll start refinancing loans and there's origination fees and points and stuff in on that as you're bringing it back down. So we're actually in a better scenario buying a bank at the higher interest rates than it would have been if we would have gotten this thing accelerated and done it a year earlier and bought it at the lower and then all of a sudden had to deal with this. I'll show you something else if you don't mind. Can I share a quick screenshot with you? Show you something that I think is cool that came from Preston Alexander. And like I said, if you don't follow him, did this come up? Do you see that? This is something that's just mind-boggling to me. We hear about these hospitals losing money and how much revenue and everything else they're running into. You're looking at 4 of the major hospitals right here. And what you're seeing is the revenue that they generate from patient care versus the revenue they're generating from investments. Okay? This is Ascension Bank or Ascension Hospital. Are they a hospital or are they a bank?
Yeah,
they're generating
it's Ascension Bank now.
$25 billion a year in patient float and stuff. They're generating $23 billion from their investments. Yeah. Providence is actually making more off of their investments than they're making off of their patient care, as is Advent Health. And then what's even worse is that we pay the price because when these investments go bad on these people and whatnot, the hospital claims, yeah, we're losing money, on the deal, and we end up paying for those investments. But these are the kind of games that the hospitals and stuff play that the physicians and stuff have been blocked from playing and don't look at. They're playing in other verticals. They're letting their money make money for them.
So this is what I understand is the financialization of the economy. This happens across other industries as well. I think I remember hearing about General Electric going through a something similar where they started essentially becoming a financial institution more than an actual electric company.
Absolutely.
Same with car companies, Ford Motor, Chevy. It's just the financialization of our economy.
And that was one of the places that the banks really screwed the pooch. They didn't think they'd ever lose their banking of the cars, but who borrows money from the bank for their car anymore? GM not only moved over, and that's one of the reasons GM is so much bigger than Ford and any of the other ones is primarily because Henry Ford didn't believe in loaning or running a debt or running money. It was one of his second in commands that really pushed Ford to go that way. Chevy got into the GMAC aspect of it, and they started loaning their dealers money in order to buy cars. And that's why GMC is so much bigger than Ford and stuff right now, not because of their market presence in the selling of the cars, but it's in their financial. This is one I wanted to share with you real quick, just so you can see and stuff as well too, to give you an idea of the power of physicians. So this is a pretty typical graph that you'll see at almost every orthopedic meeting right now. What you're seeing is the CPT code for a total hip, and this is total knee. And you can see what is projected over the 5 years. And if you add inflation onto that, you can see what a physician's reimbursement schedule to do over the next 5 years. Here's the physician's overhead that's happening every year going up. Now, I would challenge you that if the CEO of Amazon or the CEO of GMAC or Chevy or Ford was presenting this kind of a table, they would be getting fired. This is not the kind of graph that you want from your deal. But yet, when you go to every one of these meetings, right after a physician presents that graph and shows what their income and stuff doing, hospitals and PE is standing outside the door and they're wanting to buy their practice. Private equity is saying, hey, look, we'll buy your practice and stuff. Why? The why is because it's your script. It's the power of your pen. It's the power of what doctors do that drives all these other verticals that they've used legislation to block you from being part of. And being involved in a financial institute allows you to do that. Simple things like in the orthopedic world, if you've got a bank and it's doing well and it's got all this money, right now, if a doctor comes up with an idea for a new product, which most of the innovation is driven from a doctor, they'll go to Stryker or they'll go to J&J or they'll go to Medacta, they'll go to one of these companies and they'll share the idea and the company will go, man, that's brilliant, that's great. We're going to give you a royalty. They give them 0.75%. They get a 0.75% royalty because of Stark laws and other things we can't pay you. And then they take that product to market and their profits are out the top. If we have a bank that's focused, and this is something that Rick Rule is right about, talks about, if you've got a bank that's niche like this, that's focused on this, you're also going to attract that industry. And what will happen is, I do a lot of consulting work and stuff. One of the little companies I've been looking at is a little company called Oxos, OXOS, and they're out of Atlanta. Really cool technology. It's a handheld X-ray machine that you can hold it at arm's length and you get zero exposure to radiation by taking the shot. A doctor can literally not only have one of these and carry it from room to room in their clinic, but if you're working with a high school sports team or a college sport team or something like that, you can carry this to the sideline and you can take an image on the spot and put it out. And they're struggling for capital. They came to me and wanted to know how quick we'd be open and whether we could do it. Think of now all of a sudden, if you've got a bank that's got physicians and stuff, these little medical startup companies now, when they're looking for investment capital, are going to now come and say, hey, look, if I talk to this bank here and I can get money from this bank, I also get access to 600. I get access to 1,000 potential customers because the investors and owners of the bank are also the users of my product.
Yeah, a lot of synergy. Ton of synergy. This has all been great information. We are 20 minutes past the hour. This has been our longest webinar, but it's been packed with great stuff. So I'm not surprised that it would go long. I think it could even go longer. But in the sake of respect for your time and everyone else's time, if there are any final burning questions, please let us know. Otherwise, Marty, how can folks get in contact with you? How can they best engage with you?
My cell phone number and email, I can read them out to you, but I'm going to www.pfbancorp.com. Physiciansfirstbank.com has got my cell phone number on the bottom of it. My email is simply marty@pfbancorp.com. Because I understand your business, if you want to have a conversation early in the morning so it doesn't disrupt your clinic or in the evenings, happy to that. I don't have problems with Saturdays. I'd like to keep Sundays to my family, but if I have to, I would arrange a Sunday call as well.
Sure.
Awesome. Well, I left that information on the chat. I want to thank everyone for coming. Bio, any final words?
No, just thank you very much. You will learn a lot. And also, actually, in our group, we have a physician group where we talk about real estate, trading stocks, and things like that. They're actually asking how we can start our own bank. So I think we're probably going to set up another Zoom meeting with you at some point, just to talk to the group. They're really seriously considering something along that line.
And we can go two directions with that. I'd love to talk to you about that. Hopefully what we're doing makes sense and you can come along with us. If it doesn't make sense for you, that's one of the fun things about the banking world. It's not so competitive. There's enough room for more than one. So if I can even assist you, if you guys decide that what we're doing just doesn't fit and you want to go, I'm happy to work with you and help you go whatever direction you think's best in the best interest of your organization.
Thanks, Marty.
Awesome, Marty.
Thanks
a lot. Thank you, everyone, again. Everyone have a great rest of your evening. We'll be back in 2 weeks with another great webinar. Thank you again.
Looking forward to it.
All right, bye. Thank you, guys.
Bye.